Found the perfect house to flip, but you don't have the cash. Don't worry. You don't need $1 million to start flipping a house, but you just need to know where to get the financing. In this video, we're going to break down how real estate flippers actually get loans, even if it's your first deal. So first, let's start off talking about understanding what lenders look for. So lenders care about the deal, right? Not just your income. So it's not going to be like a loan with a traditional bank. We're going to look at like your personal informations. Most lenders are going to look at the deal and your track record. So things that you have to know really well, whether it's to individuals or institutions that you're going to get the loan from, is after repair value, what the home will be worth after your renovations, and then what's your purchase price, what's your rehab cost, and how's that compared to the after repair value, right? What's the profit margin on that, or do a kind of a line item breakdown to show other costs such as financing costs, holding costs, and everything else in between to see what type of profit and margin there is for the lender that they're lending on and what your exit strategy is. Your experience level matters as well, I should say. Many lenders, some lenders out there just don't lend to first time folks. However, if you partner with someone else, that's a great way to get jump started. But um, some individuals might just not want to lend money to someone doing their first deal, and I get that. Institutional lenders or hard money lenders are more willing to do that, but your pricing is going to be a little bit higher. You might have to pay a few more points, and we'll get into that later in higher interest rates. And then you got to have sometimes multiple exit strategies. Like, what's your plan what's your exit strategy? So, are you just going to buy, do some minor renovations, and relist on the MLS? What if the house doesn't sell? You want to take it as a rental and get a long-term financing in there so you can cash out your short-term lenders on your flip. So, having different exit strategies, understanding what you're trying to do, is good to have talk about that up front with your lenders. Next, we'll talk about common types of loans for house flipping. And it is a few different groups. The first group are your hard money lenders. These are short-term loans, usually 6 to 12 to 18 months, and they're going to be based on the property value, not your personal credit. And you're going to get fast approvals with these, and they're great for competitive markets. These are people that look at real estate flips all the time. That's how they, lend their money. So they're really good at evaluating a deal. And it might be actually a good idea if it's your first time to utilize one of these hard money lenders because they're not going to lend on a deal if they don't think it is a deal themselves. However, since they're fast and they know what they're doing, they're going to charge you higher interest rates and points or fees. So, interest rates from a hard lending lender, again, it's going to vary based on supply, demand, and interest rates in the market. It could go anywhere from 8 to 15%. And some of them are going to charge probably 3 to 4 points. I've seen as high as five on some. So what a point is essentially if you're borrowing $100,000 from them and someone charged you 2 points, you're paying the lender at closing $2,000 essentially on top of the interest payment. So those are two pricing factors to be aware of. The next group is not hard money lenders, but what I call private or individual money lenders. These are just individuals. They're not like a company dedicated to hard money lending. So these are individuals that are just in like your circle of trust or relationships. Most of these people don't advertise. They can be more flexible with their terms than a hard money lender or a bank. And they often like to invest with like more experienced flippers or some flippers that have done a few deals along the way. So a good way to meet these people is going to like a local real estate meetup or a local REIA, real estate investment association. You can find a lot of private individual lenders there. And again, their pricing is going to vary significantly. I've utilized private lenders with 0% interest or 0 points and like 8% interest. Some like a point or two. Some want more interest. And they're flexible too. Some might not want interest payments every month. They just don't, they want less accounting and less money flow. It's here's the money up front and just pay me when you finish the flip, interest and their principal back essentially in, at any points. So it again varies by lender. They're the most flexible essentially from paperwork and other things. Next are kind of fix and flip loan companies or investor loans or asset-based lenders, they're called. These are essentially specialized lenders, and they'll look at the purchase price and the rehab costs, and sometimes in one loan, or sometimes here's the purchase price, and then you won't get the rest of the money, like the rehab until you hit certain milestones and stage gates during your flip. And then usually, they'll charge interest only payments monthly until the property sells, and they get the principal back as well. So if you're paying, 10% interest and on a $100,000 loan, you're going to pay 10% divided by 12 times 100K, and you're going to have to have a monthly payment to them every month. Again, they're kind of like a different type of hard money lender, but usually more better pricing on the interest rate and point side. They have a lot of money backing them, and there you got to deploy that money in fix and flips as a product line a lot of these folks offer. Then sometimes it's, hey, you might be sitting on money that you're not even aware of. A lot of people, homes values rise a lot the last 5 years, and you might have home equity. You might have equity in your home, and you could take out a home equity line of credit essentially. So if you own a home and it's worth 500K and you only owe 200 on it, that 300K difference is something you borrow on. And the interest rates vary. Usually it's a prime plus or minus a few basis points, such as like 25, 50 basis points. And from there, you pay interest only along the way on what you borrow, and your house is essentially collateral on that line of credit. So I've used HELOCs over the years to do private credit spreads where the HELOCs were really low, and I would just take out the loan, it'd be 3%, and then getting 12 to 15%. And other times I'd use it on our own flips where you take out the home equity line of credit to buy a property, fix it, renovate it, and then pay it back to home equity line of credit when you're done. So it's just another asset you might be sitting on that you're not aware of. And then, lastly, if you're newer or if you're even seasoned, you just have too many deal flows, you could partner on some deals with some individuals, right? For example, if you're new and you find deals and you know how to bring someone in to do the construction work and you don't have the money, you could find a money partner, and maybe you guys do like a joint venture on a property and do a percentage share on a profit sharing where someone might get 60% of the net profits, the other person might get 40% of the net profits, depending on what everyone brings to the table. So those are some of the funding sources that you could utilize. Now, what are you going to need to qualify? And it's going to vary by each of those folks that we just talked about, from hard money lenders to individual lenders to asset-based lenders. But essentially, the common theme is, right, it's got to be a solid deal, and you have to have all the analysis to support that. Show that you know your numbers. What are the comps to support this after repair value? I've gotten 3 quotes to come up with the renovation project, and then there's holding costs, and there's financing costs and closing costs. And you could easily break down to show folks what the profit is at the end of the day so that you know the numbers and they'll feel more confident in the deal. Understanding the scope of work and rehab budget is another key thing. The comparable sales backing the after repair values you need. What's your experience or credibility, right? Is you have a construction or contractor background? Do you know how to list the property and comp properties? Do you have good agents on your team, etc.? So who's your team and what's your experience is going to be important as well. Some of these lenders might want to check your personal stuff, like a credit score, to make sure there's not like bankruptcies out there on you, and you're credit worthy as an individual on top of deals. And then down payment, what are you looking to put down, right? There's different programs from asset-based lenders that they'll fund on purchase anywhere from 80 to 90. And I've gotten sometimes on specialty deals where they'll fund actually up to 100%. Individual investors might have their own criteria. It depends. Even the hard money lenders or the asset-based lenders or individual private money lenders, they're all going to have their own. What skin in the game is it for you? The real estate flipper need to bring 10%, 20%, or 0% down to the table? And it's going to vary by deal. So those are some of the things that you got to be really understand to qualify for someone to lend on your deal. Now, some tips on getting approved. So you want to build relationships with local hard money lenders, individual lenders, and asset-based lenders. It'd probably be a good idea just to have a few irons in the fire essentially and continue to build those relationships, because as you do one deal and you do a few more and more, it's always had a good problem to have funding opportunities when these deals come about. And always to get approved, always have your numbers ready. Know your purchase price, rehab, after repair value, and profit. Got to be realistic with your costs and timelines. Don't Be a little bit conservative in some of your numbers when you present the deal to someone. And then you want to, start with a reasonable rehab and so you can build a track record of success and more financing will easily come to you. You'll get lower interest rates, lower points as you build a track record and experience in real estate flipping. Now, some key takeaways here is, you don't need a traditional mortgage to flip houses. There's hard money, there's private money, and there's partnership funding are the most common ways to fund these deals. And this deal itself is your biggest leverage. If it's profitable, funding usually flows to it. You just got to be able to prove to people the numbers make sense. So, if you found this helpful, smash the like button, subscribe for more real estate investing tips. And then in the next video,